And now inflation has been inside the central bank's target of between 3 and 6% since February 2010, but has risen since, hitting the five-year low of 3.2% in September in 2010. Transport and food costs have been the main drivers of inflation. Russell Lamberti, strategist at ETM, now talks things all economic with us, and of course focusing on those October inflation numbers, which clocked in at exactly 6% year on year in October, and pretty much not in line with expectations. Consensus was 5.9%. So we're starting to, of course, coming to a very dangerous zone where we could actually breach that by the end of this year. Would you say that's the right
Looks
prognosis?
like it. I mean, if we're at 6, it certainly looks like we could breach the upper limit. I think it is telling when the market kind of misses the forecasts just a little bit each time, and so it does give you a sense that perhaps there's more sting in the tail to this inflation cycle than we had thought. We had been very dovish on inflation expectations for a long time. We had expected that it would rise this year, but the extent of that rise and the tail of that rise has been a lot stronger than I think a lot of people thought. And I think a lot of that has to do with the sell-off that we've seen in the currency and what's going on in Europe. We can get to that, but certainly there's no doubt in my mind that with prices doing what they've been doing, it's placed a lot of pressure on consumer wallets, and I think that's why we've seen, we've come through a difficult economic patch in Q2 and Q3 this year.
Okay, well, we're not seeing it really coming through in the core inflation number, and I know that you have been an advocate of a much lower inflation environment because the money supply is still relatively low. Private sector credit extension has also been relatively low. Has it really been because of the local currency weakening quite extensively, and also administered prices just rising beyond our expectations?
It's a whole range of factors. I think it would be unfair to say that credit growth is now kind of just stagnating. We are seeing some credit growth coming through. That is translating into some money supply growth that's getting going. So there's some fuel to this inflation fire. But it's definitely been a strong currency, well, a weak currency story. Strongly, it's been the rand sell-off that we've seen, and really what we're talking about is the demand for local currency has just really disappeared in the last couple of months. That plays a role in prices at the margin.
Do you think that the MPC was right to make no move on the interest rates?
Well, it's an interesting one.
A lot of people were talking about 50 basis point cuts, and others were saying, okay, definitely no move.
Yeah, I think it was, the guys who were calling for cuts are typically the banks, and the banks always seem to call for rate cuts. I'm not sure whether those are forecasts or wish lists, but I think that what we've really been seeing is a Reserve Bank that's content to stay on hold, and really central banks that are ignoring the inflation problem. So inflation came through this year. The Reserve Bank hasn't hiked rates, and we're at the top of the band of a base of historically low interest rates. You would have suggested that we should have been hiking for a good few months already. ECB is cutting rates again. Bank of England's gone into more QE. The Fed certainly isn't doing anything in interest rates, and they've got an inflation problem coming. So in a way, what we're seeing is inflation targets are being implicitly increased, even if not explicitly said so by the central bankers. They're raising the inflation forecast.
A couple of years ago, we spoke of the fears and the risk of stagflation. Are we actually going to head into this? Because now we're actually sitting and debating the actual definition of what stagflation is. And they say that anything below growth below 3% is, of course, quite dangerous when you have inflation above 6%. Is that the right definition? And are we heading there here in South Africa?
Well, we don't like to define these sort of terms too technically. I mean, people talk about a recession. What's a recession? 2 quarters of negative growth, and there's all these kind of definitions. We're firmly entrenched in stagflation right now. Certainly as a global economy. Certainly if you look at the UK, inflation 5%, growth 0%. That is stagflation. The US is not quite as bad. Europe is facing a stagflationary environment. South Africa, to some extent, the same thing. And in a way, people ask, well, how can low growth and high inflation coexist? Well, actually, they're very symbiotic because high inflation undermines real purchasing power, it undermines consumer wallets. It's actually part and parcel of the same thing.
Do you think that the US can actually be put into this debate, given the fact that they actually only look at core inflation as opposed to actually looking at an inflation basket, which we look at, which includes everything, headline inflation, so to speak? Because our core inflation, if we had to look at that relative to the growth levels, we're actually sitting in a very comfortable place.
Look, I think, core inflation as a measure has its merits, but at the end of the day, you want to look at what is going on with prices in general in your economy. And in fact, we should add more things to CPI. We should probably be adding, measures of asset prices, equity and house prices, if we want to get a true sense of what prices are doing in aggregate. But look, the Fed might focus more on core inflation, but we focus strongly on overall price measures, not just CPI, but what's going on in asset markets. If you look at America, there's a lot of buoyancy there right now, predominantly emanating from this incredibly strong credit growth that we're starting to see come through in the States. So banks are lending, money supply is growing in America, and really, if it wasn't for the mess that is Europe right now, if the ECB were to, kind of get on the printing wagon and liquefy their system better and kind of calm nerves and so forth, I think we'd be seeing a big reflation trade globally, and a lot of that money would be heading onshore to South Africa.
I go back to the fact that the US does only look at core inflation and really doesn't look at all the the things that we look at, but you're saying we should actually be adding things to our inflation basket. Wouldn't it just suit us if we just looked at core inflation like the US, so perhaps we are looking at a slightly better scenario? Because if you had to look at the headline inflation number in the US, it's vastly different from, I think, the minus 0.1% that it clocked in not too long ago.
Well, look, I think there's merits for both. So I think core can give you a sense of some underlying structural price problems, whereas the overall measure, might potentially just show you some transitory effects of oil prices and shorter term things, and that's why they want to strip it out, because they want to see what the sort of structural price pressures are and so forth. But I think from a real economic perspective, the more accurate your inflation measure, the better you're going to understand how the consumers are doing, how they're responding, how their wallets are being impacted, and really what you want to do in that scenario is look at a holistic picture of CPI as you can, and also just to get a sense of true inflation in the economy. In other words, what is money supply doing to prices in general? You need to look at asset markets as well, and so you need a holistic picture. But look, I think South Africa is where we've really been hit hard is with the supply side cost administered prices. A rand that goes to 850 on commodity prices overseas that haven't really fallen very far is a cost squeeze, and so I expect to see some pretty big pressure on margins going forward.